This is Jody Trana, presenting the last unit of Cash is King, Unit 4, Making the Most Out of Cash. In the previous units, we focused on the value of tracking cash and how cash is generated internally and found externally. This unit pulls it all together to discuss how to make the most out of cash. This unit will help you answer the question, okay, now what do I do? Now that I know this about the business and cash flow management, what should I do? You've made it this far in the course, and I'm sure you understand the point of the course. Cash is king. But let's make sure we're in agreement as to why cash is king. We've discussed one primary point concerning the importance of cash, and that is survival. Another important purpose is to be able to jump on opportunities in order to create even more cash. But why all this cash? One reason is to have freedom. Freedom to take a business anywhere. Here's an example of one entrepreneur, Bill Austin of Starkey Laboratories. Bill has always had the passion of helping people to achieve the gift of hearing. So he built a business providing hearing aids that creates enough money for him to advance his work through a foundation. His company has grown into a global technology business that manufactures some of the finest hearing aids with the most advanced technology in the world. And his foundation has been able to provide more than 310,000 hearing aids to needy people around the world. That's the point of creating a business that makes enough money to provide the profit and cash flow desired. It gives the business freedom to pursue its dreams. In this unit, we will discuss strategies to make the most of your internal cash sources. Our first topic will be about using cash flow wisely. Then we will discuss strategies to build cash flow and protect cash flow. Finally, we will draw the discussion back to you and your role as a cash manager. There are 3 topics around using cash flow wisely. They are making good decisions concerning the business's bank, borrowing, and budgeting. Let's talk about each one of these areas in greater detail. It used to be that businesses would choose a bank because of its location or loyalty. But banking decisions today should be more strategic. Evaluate the financial services the business is getting today and compare that to services this business may need in the future. If you're not sure, discuss the business with several banks or financial institutions and find out what services they offer. Here are some factors that affect the banking services you may need. How much cash flow goes in and out of the business? If there's considerable cash flowing in and out, you may need to have a sweep account to automatically invest excess cash. Or would you benefit from a bank or a banker with specific industry expertise? If you have a specific business model, such as online retail or a certain industry, you may benefit from having a bank or banker who understands your business. Your chances of getting loans or lines of credit are much better too. Could the business maybe save money or increase cash flow by taking advantage of some of the services the bank or financial institution offers? Ask yourself these questions when you're evaluating banking services. One tool that can help small businesses manage cash flow is treasury management. Traditionally, treasury management has been thought of as something that only big businesses do. It means things like electronic check processing, electronic automated clearinghouse, documents to pay bills, and automated payroll, where automatic deposits from the company payroll account go directly into employee accounts. A lot of these services are being used for all sizes of businesses and are reducing costs and increasing cash flow, and they help reduce fraud. One Chicago-based home theater company with $10 million in annual sales switched from his traditional bank to an investment company's central asset account. The new account combines a checking account, money market, credit line, and a brokerage account. So he can move money around manually or automatically, and he can set the desired balances. By doing this, they've reduced their overhead costs, they've reduced their interest expenses, and they've increased their investment income. Consider what might benefit your business. Being debt-free is a fine goal to have, although most companies will need to rely on debt at some point. Here are some borrowing strategies to consider. First, put borrowed money to work, building profitability and cash flow. Don't borrow money for things that aren't profit producing. Borrowed money has a cost associated with it, and the profits offset the cost. Second, the business should have the right amount of debt, not too much and not too little. This can be evaluated with debt ratios. Debt ratios show how much debt is being used to support the business. And third, match debt sources with uses. Let's talk more about this one. The third borrowing strategy is shown on this slide. It says that the right amount of funding should be sought from the right sources and used for the right things. That's the matching principle of matching debt sources with needs. On this slide, you can see that the business has short-term needs to cover accounts receivable that hasn't been collected yet to buy inventory. These short-term needs should be covered by short-term funding sources, such as a line of credit or factoring. Long-term sources, such as loans, investors, or IPOs, overweight the funding balance. This imbalance happens for two reasons. First, because the short-term cash needs are not paid back in the short term. So let's say there were two buckets, a short-term bucket and a long-term bucket. We just filled up the long-term bucket with loans to meet short-term needs. But what if some long-term needs arise? We won't have any borrowing power left in our long-term bucket. A second reason that the imbalance happens is that the long-term sources are going to cost a lot more than they're worth for covering a short-term need. We've messed up both our cash flow and profits with this mismatch. The final strategy for using cash wisely is to budget for cash. Most established businesses operate with some type of a budget, but it's usually a profit-centered budget, not cash flow. When cash flow becomes a significant goal for the business, there should be a cash flow budget too. The difference between a common profitability budget and a cash budget is that the cash budget will include estimates for future cash needs, such as equipment, dividend payments, or loan paybacks. Having a cash budget and reviewing it regularly promotes changes. Christian Springup from Jimbo Web Hosting Service does a quarterly review of every invoice he receives. He asks, is this service or product necessary? Is there a comparable service that will be a better deal? How can I avoid these costs in the future? By analyzing every dollar out the door, you'll find areas where you're throwing away money by overpaying or using services you don't need. That concludes our section on using cash wisely. In this unit, making the most out of cash. The next section in this unit is about building cash flow. Building cash flow involves improving cash flow ratios, shortening the cash conversion cycle, increasing profits, and bootstrapping. We're going to jump right into shortening the cash conversion cycle, as improvements here will likely improve the cash flow ratios as well. The cycle uses 3 measurements based on how long cash sits in inventory, accounts receivable, and accounts payable. So to improve this cycle, cash needs to clear more quickly out of inventory and accounts receivable, or cash may need to sit a little longer in accounts payable if your vendors would allow it. Here's an example of poor inventory management. A graphic designer we're calling Mike had so much business, he had a hard time completing work. So much, in fact, that he wasn't always able to complete work on time. A few projects had to be dropped midway as the customer was unhappy about how long it was taking to complete the job, and they dropped Mike as a designer. We always think about having too much business as a good thing, but in reality, being slow to complete work puts a strain on cash flow. As an individual contractor, Mike could have had as much as $30,000 tied up in inventory, with some of that being written off as the work he didn't complete soon enough fell through. Here's an example of an inventory solution. One audio equipment company found a creative way to reduce their obsolete inventory. They had 15,000 speakers that they couldn't sell, at least not to their current customers. So they decided to have an anniversary bash and gave away all 15,000 speakers. In exchange, they got 8,000 new customers and made 7,000 existing customers really happy. Let's talk about accounts receivable. Here's a poor example of accounts receivable management. An aviation company that provided corporate flight services had a high net profit, but they always struggled with cash flow. After a review of their accounting system, it was noticed that their billing process was to send out one monthly invoice with no follow-up statements. So if that one invoice was misplaced or unpaid, the company would follow up by phone several months later. A replacement invoice would be sent if they requested it, and then a month or 2 later it would be paid. This put a huge strain on cash flow. Here's an accounts receivable solution. One catering company that specialized in public schools had a large cash crunch as the local school systems would take so long to pay. They were good clients though, and so the payment was sure. So the catering company was able to get financing against the accounts receivable to cover working capital costs. And here's an accounts payable solution. One company took a look at their days payable outstanding and found that they were paying on average in 23 days compared to the average in the industry of 41 days. The solution was pretty simple. They reviewed their vendor payment terms and updated their accounts payable system to reflect a 35-day payment schedule. Believe it or not, this in itself resulted in $208 million in additional cash flow. It may seem in this course that we've been spending a considerable amount of time downplaying profits in an attempt to raise our attention to cash. But the truth is that profits should be the number one source of cash for a business. So if cash flow needs to be improved, profits need to be evaluated. Remember the profit equation. Sales less cost of goods sold minus expenses equals profit. So when you're evaluating profit, you need to look at these three areas. It isn't just that simple though. Sales is a function of selling a number of products or services at a certain price. So to increase sales, a number of things could happen. The business has lots of options. They could raise prices, although the business isn't guaranteed to sell the exact number of products or services at an increased price. They could sell more products to existing customers. They could sell more products to new customers. And they could add additional products and services. Each one of these strategies has potential challenges. The other profit pieces, cost of goods sold and expenses, they have the same complexity. We could have a whole course just on this topic of increasing profits. But to suffice it to say right now, if cash is lacking, it may be because profits are lacking. Simple activities can make a dramatic change in business. One entrepreneur, he was frustrated because of his flattened sales figure. When he reviewed his customer list, he noticed that his best customers rarely visited his retail location. He thought that was odd since they were such good customers. He never invited them into the store, though, or even encouraged additional sales. He just had never thought about it. His marketing efforts were all concentrated on advertising, which obviously wasn't doing anything to build sales since they were leveled. Simple, targeted marketing efforts to the good customers was what was missing. I saw an article in the Huffington Post called 14 Unusual Tips for Trimming Your Business's Budget This Year. Check it out. The ideas were really interesting. Here's some of the bootstrapping ideas that the entrepreneurs had. Rain, which is a digital marketing planning agency, they saved $125,000 per year just by having purposeful, efficient meetings. Opportunity, an online professional matching service, saved thousands of dollars by bartering. They provide free advertising to their site users in exchange for services that they used to pay for. Susty Party, which is a high-end disposable tableware business, they moved into a space that allowed them to grow. While they don't need all the space, they're renting out desks to freelancers and other small businesses. Sullen Clothing has saved time and money on marketing by concentrating efforts on their YouTube video creation. They now have affiliates who pay monthly to sponsor the content that they've created. This advertising pays for itself. Speak, a free conference calling service, reduced their marketing budget by reducing paid advertising and concentrating on effective search optimization and word of mouth. Bootstrapping should not be a recovery tactic. To some extent, the business should be bootstrapping every day to avoid unnecessary costs and improve profits. The next section in this unit, Making the Most Out of Cash, is a discussion on protecting cash. This isn't a very upbeat topic, but it is the reality today. American companies lose billions of dollars every year to employees who steal or embezzle. If you think this doesn't happen in your business, think again. Fraud prevention experts believe that 10% of employees will always steal, 10% of employees will never steal, and 80% can go either way depending on the circumstances. The good news is that implementing cash control strategies will help keep the 80% from stealing. The first thing to do is to assess the business's vulnerabilities. We're talking about protecting cash at this point, but when companies lose inventory, supplies, and equipment, it affects cash too. Any theft hurts cash. A financial expert may be needed to help establish the areas of business where controls are necessary, as businesses all are a little different. The next step is to build cash controls. This is done at both a high level and a hands-on level. Here's the difference. A high level of control means that the company core values and standards of operation support integrity and honesty. For example, a core value of open communication can encourage people to ask questions and bring up issues. And a standard of operation that people should cross-train can help identify errors or fraud as people share jobs. There should also be specific key controls of cash activities, such as physically locking up cash in the checkbook and making sure each cash transaction involves more than one person. One to write the check, one to sign it, and one to post the check into the system. There are many other ideas you'll find in the reading materials. And of course, a financial expert could advise on a particular kind of business and its cash protection needs. So what is your role as a cash manager? Terry Allen, a serial entrepreneur who started over 20 different businesses, recalls his Welcome Wagon business that targeted new residents with coupons for services and products they would likely need. He knew the business would be profitable, but efforts to make it cash flow friendly were important. The coupons were printed and sales reps paid in advance of collecting from the merchant. So improvements to cash flow would include getting a deposit from the merchants that would have at least covered the sales rep's commission. Whether you are the entrepreneur like Terry Allen, a leader in the business, or a decision maker, you have an impact on cash. Even if you think you have very little influence, you still have some. Think about the area of the business that is within your influence. The process of creating profits and cash flow is a company-wide activity. Everyone in the business contributes towards this. The way your team members answer the phone seems like a small thing, but it is one activity that contributes towards profits. Think about your area of influence and ask yourself these questions. If you're in sales, are you selling to customers who pay their bills on time? Are you in accounts receivable? Can you talk with customers about payment terms? Are you in customer service? Is the customer service encouraging good relationships and quick payment? Are you in product development? Is the product free from defects? Are you in the mailroom? Are invoices mailed out quickly? Are you in purchasing? Do you time purchases based on cash availability? These examples show positive influences that a person can have within their area of influence. Here's some more examples. Maybe you're in the engineering department. Do you request special products all the time? Are you in the stock room? Do you like to have lots of stock on hand just in case? Maybe you're a plant manager. Do you request new equipment every year? Are you in the IT department? Do you always want the latest upgrades? These examples show the non-financial areas of business that can have a negative impact on cash flow. Begin to think of your department or area of influence as a part of the cash flow wheel. You'll be greatly valued by the company. Focusing on profits is great. Profits feed cash flow. But understanding and managing cash flow will put you head and shoulders above the rest. Just remember, cash is king.